Good morning, class. This is your instructor. My name is Maliha Beg, and I'm going to be talking a bit about the cost terms, the valuation process of costing, in which we have to assign some costs to the cost product. So also we are going to be talking about some of the practical implications of planning and control decisions. So the first thing is cost terms. This is LO1. Then second thing is we have to do some practical implications for planning and control decisions. Planning and control decisions. So there's going to be just a numerical example. It's not going to be a numerical, it's basically an analysis. So it's an analytical example for you to think about. Then there's going to be phase where we do some numericals. If it's possible, we can do 3, otherwise maybe 1 or 2 examples for you to basically wrap your minds around how to ascertain costs. So now, beginning with the LO, which is 1, we go ahead with the cost terms. A few of the terms that we have done before, but before also that, the relevant chapters for today's lecture are Matz Usury's 1, 2, 3 chapters. We will be discussing few numericals because they have some combined course content, but that has been segregated into 3 chapters. First one deals with planning and control. These 2 would be about the cost terms, and first and second chapters of Horngren. So relevant content, so this is going to be covered from these 2, and that is going to be 16th edition, and that will be 7th edition for planning and control. Now, when we talk about the cost terms, first of all, you need to understand what is meant by cost object. So you can think of a thing for which you measure the cost. So it's going to be a thing of interest for cost measurement. For cost measurement for which cost ascertainment. So I'm using this word cost. I'm going to be putting it in inverted commas so you know that this is also a term. This is going to be cost ascertainment is required, is the something that you really want. Required. Okay. So now, cost object could be anything for which you ascertain cost, for which you want to measure the cost. So I can give you an example of car tires, car doors, any inventory, okay, that the company makes. So what would be an example? Inventory or items made by a factory. Manufactured. Okay, so this is going to be items that have been manufactured. Our cost object, but this could be any product of interest. So things could be a product, right? So you can have interchangeable terms and a few other alternatives. Now this term implies that when we in the future talk about what to value for, basically. So first of all, there's what we are going to value and for whom we are going to value. We are going to be valuing for financial statements, excuse me, because we need to determine and evaluate the cost of the product so that we can report our costs in the financial statements and in the income statements. This is the purpose for which we want it for. And then the thing is what we are actually valuing. So this, what is that product that we want to ascertain cost for. After this, we have some type of costs, a few that we did, and I have to rub this off. So the first thing was cost object. Then we have this term as cost ascertainment, which is just a process for measuring the cost. Then there are a number of types of costs that we are interested in. Okay, so first is the differential costs. It's not to say that we don't have any principles or standards pertaining to cost. We do have the CASB that was formed on 15th of August 1970, okay, and this deals with the cost accounting standards board, okay, so this was in North America and applicable to other parts of the world. We have ISBs, then we have ISB and the relevant, ISSs, which are the International Accounting Standards, and we have the costing standards as well. So this was the first to actually raise the awareness for the importance of the principles for cost. And this is still applicable for finding out the effectiveness of the measures to measure cost. Then there are some performance measuring features, I would say. So before we do the differential cost, just to make you understand why we require these principles or standards like we do in financial accounting is we want to find out the performance indicators, the performance measures or measurements, okay? So I would just say performance measures at the moment because there are some internal factors. So there are some internal factors of a company. Then there are some environmental factors, okay? And there are some interdepartmental factors. So we have interdepartmental factors and we also have environmental factors. So what could be the internal factors like cost object product or cost object valuation, productivity. Okay, so there could be some some other measures like planning. If you want to plan or make plans for or evaluate what you want to do next. So kind of like some part of planning for the cost object and other measures. Take it. So we have measures. These are planning, could be planning measures pertaining to cost object. And there are many other internal factors like how the personnel is dealing. So these could be in terms where with interdepartmental factors like the HR or personnel. How this personnel is dealing with one another. Then interdepartmental costs, and many other factors. You can just go to the chapter and you can read the details. But generally, if you understand, it has to be harmonization, and there could be costing, valuation, how you are perceiving, what could be the productivity and market share. Then there could be other things like we have internal factors, and we could also have some external factors. So when we have external factors, what could we have is market share. Market share really matters because you can find out whether your product is actually required. You want the particular target market, whether that is something that is of the taste of the customer. So it's just not enough to have a target market focused on. You also need to know how much your product is valued. That becomes again important for environmental factors because Again, dealer opinion is very important. Environmental diversity is important. How much substitutes are tolerated in the public, okay? And then there are other factors like, environmentally, how feasible it is for you to have your product launched at that time. It has to be friendly. It has to be, there has to be some acceptance, and it has to be, some sort of suitability for you. So there has to be some diversity, suitability, and then there are planning procedures which can actually work in cohesion with all these if it is harmonized. So environmentally, it has to be harmonized. Now these were the key performance indicators. I'll have to rub all this. So now you know that for diversity and planning to work properly, you need to have harmonization, and also the HR has to be well connected with the personnel so that working is smooth and without conflicts. And there also should not be any conflict of interest with the management. So then that's why we need principles in the first place. Then we come with further terms such as the differential costs. Now what are the differential costs? So first of all, differential cost is having two options with yourselves, right? So this is option 1, and it's going to be option 2. So if you, like for instance, the quality of furniture for this university. Okay, so this is just an example. That we want to have particular type of computers, we want to have particular type of table on which we want to place the computer. So if we go to one shop, perhaps we can have this table set for $1,000, which would have the complete solution, like having the tabletop, the desktop, the chairs. So all this for one, maybe a room with the multiple chairs and multiple tables could have this solution for $1,000 for one room, for one small department, right? And then this could, for employing, the other option could be $1,500. So the difference would be about $500. That means if you choose a lesser expensive option, you could save your $500 in return. So you are going to be getting back your $500 in this case. So otherwise there's going to be an outflow. So this is going to be a cash outflow if you select a more expensive option. This is the differential cost. So that means when you ascertain the cost for two alternatives or between two alternatives, these options are two alternatives. So any cost differentials that might happen in the future, okay, so these are future costs too. In a way they are, because you're going to be employing a different option. So these are going to be a type of future costs, you can say. And not just only one, okay? We have some other costs. I hope you get this, that you have to decide between two alternatives, and the cost for the future rests upon which alternative you decide upon in order to obtain one of the two options. But remember, this is not the same as opportunity cost. It is not the same as opportunity. So students actually mix up both these costs. It's also another type of cost, but opportunity is more to do with the substitutes, okay? So that has to do with choosing one substitute over the other. One substitute. Rather, it's not a substitute, okay? So it's just choosing one product over the other, because there would not be a substitute exactly. So over the other, though one might be better than the other, okay? So it could be two different products, but since you could only afford one of them, so then you have to weigh the importance of either of them. And you can't have both. So there's an apple and an orange, right? This is a typical example. Now you don't have money to buy both, so you would just decide either you want apple or you want orange. So in this case, then you would decide with the apple. But when you talk about a cheaper substitute or an expensive substitute, It could be like, for instance, maybe a good quality apple or a bad quality one, right? So in that sense, you can use the word substitute, but this is a cheaper substitute. A bad quality thing, but since you can afford it better, you might be getting that. But the opportunity cost would be the cost of, deciding in favor of the cheaper product and not being able to acquire the higher quality product. So when you compromise on the quality, in this case, this would be the opportunity cost because you're compromising on the quality of the product. So what you eat, you might not be getting the benefit of eating that thing as much as you would have had you gotten a better quality thing. A better quality honey, for instance. Some are made with sugar, some don't have any unnatural sugar, so processed stuff is not inside honey. But if you have highly processed honeys, there could be some sugar mixed inside as well. We don't know about it, right? So this could be another example of that, and there are scores of examples that you can just decide upon. Something that you want more, and you skip that in favor of something which you want less, but you could afford it better, right? So this is the opportunity cost. When you talk about differential cost, it's not the case. You have two alternatives, but they're not exactly substitutes, and I won't say that you just have two choices. You can have decision of whether you want this one or you want that one, but if you decide in favor of this, it does not mean that they could have higher utility, okay? You would be indifferent to the utility of both, okay? So the thing is that there is indifference, which is of key importance here, because in opportunity cost, you are not indifferent, okay? So this is, you are indifferent between two options, just that you exercise an option for a more expensive product compared to that, but the quality could almost be the same, and it is not an opportunity cost, because if you take this one, you're not going to be losing out on the utility of the other product in this case. So I've given you an example of furniture. I've given you an example of tool makes, computer makes. You're indifferent between HP or Dell maybe, right, or Acer, and both could be of a particular model. Both could be having almost the same utility for you because you're not very tech savvy or not very conscious about what you want, the features that you want are present in all. It's just that you decide later on to switch to the option which is at that time more available to you. Let's just put it this way. So then this would be a differential cost because you decide in favor of the other option. And it could also be something else. I'll give you another example that if there's an existing furniture with you and you decide to replace that, okay? So then there could be another thing which is replacing something. So when you replace something because you want it with better stuff, you're going to now put on something, maybe either get it fixed or use buy something which will replace this existing material. So you're going to be excising the more expensive option in this case. So you will be putting in more money to excise that option. So whichever option that you excise, it's not a problem of affording, okay? But an opportunity cost you have to afford. But in this case, you don't have to afford, right? So now this will be replacing, excuse me. Please recording chal rahi hai. Now, I hope you just try to get this, that whatever option you employ, not because you weren't able to afford, but rather that you just wanted more. So you are going to just go for that option. Then you have to pay extra cost. Or if you save something, but anyway, the differential cost would be when you don't save something naturally, because then you'll be saving on those. So if you incur differential cost, it means that you decided in favor of the second option in this case. Now we have done differential cost, opportunity cost, and third one is the relevant costs. And there are some terms such as, cost drivers. The relevant costs. Now these are also future costs. Okay, so relevant costs for us are future costs, but these costs are incurred once you start with the project. For instance, they could be occurring in the future, and as and when they occur, so you have project cost, for instance, incurred along with the completion stages, of the project, this project. Completion stages of the, it's just, I think, complete. Project costs incurred along with completion stages, or you can just simply of the project. Complete line. Now this is relevant cost because these are related with the project that you have that you are interested in investing in. So you are going to expand that project and keep incurring costs. For instance, the university would decide to enhance its campus size, or maybe include more buildings, add more buildings, or construct some in some other campus, open a new campus, or open a new business somewhere else. These are the relevant costs. Okay. So now the cost drivers, another term we might come across. Cost drivers are things that move up the cost. So any, or you can say that any drivers are basically all particular costs that, or items that move up the cost. These could be, except for that, these are the things that basically push the cost up. So you can just say all particular items that move up the cost, or these are some of the things that are related particulars of a cost project. So now the reason which would result in cost accumulation is dependent upon things that drive up the cost. And things that drive up the cost are cost drivers. It means that those things or relevant particulars that can raise the cost. So these are cost drivers. All particular items that could raise this and move up the cost, basically the shift up the graph of the total costs, these are the cost drivers. So I've used the term particulars in two senses. One is in the term that particular costs, particular item means specific items. And the relevant particulars means that those things that could drive up the cost, okay? Now, there are other types. We go for the type of costs. We have also done the joint costs, and these are basically sort of like the type of costs other than what we are going to be discussing. So we did the common costs as well. So you have to remember to go back to that lecture. Then we have the fixed costs, the variable costs, and the semi-variable costs. Semi-variable costs. So now, the fixed costs could be that increase not, okay, so that they increase not with the increase in productivity. In other words, they go down when production goes up. That means that fixed costs go down when production goes up. Can you give an example? So if you think about an example of fixed costs, it could be the salary or the supervisor's salary is more like a semi-variable cost. I can put it here. I'll just explain in a while why is it so. Fixed cost could be something which does not change, like depreciation. It could be insurance. It could be rent. Okay? Anything which would not affect the productivity, but rather get lowered with the production enhancement. So let me just rephrase that. Fixed costs are costs that don't change. I mean, whether you produce something or you don't produce something, they will still be incurred. So they are independent of whether you produce something or not. So for instance, you have to open the plant and run the facility. So now, naturally the plant depreciates with time. Whether the productivity is low or high, these costs would be, let's say, depreciation per annum is $10,000. This would not change whether you produce 10 cars in a day or 1 car in a day. Insurance is paid annually or it is paid at the beginning of the year. So this insurance could be for fire insurance, this could be for medical insurance, but medical insurance comes under semi-variable cost, either medical insurance. This could be plant insurance. Now why I say it's fixed? Because you have to pay for the facility's safety. It could incur, like, the Baldia factory incident where, it caught fire, and this is very common, that factories can, catch fire, and it could be because of over-competitiveness between, there's a cutthroat competition, so there is between maybe oligarchs. And then there could be some other reason for it. There could be some enmity between two competitors. Other than that, it could be some natural cause as well. And you can have some earthquake also, destroying the entire building. So this dilapidation could be covered under this insurance. And then you have rent to pay for, and this does not get affected irrespective of whether you are opening the factory or not. Just for occupying, you pay something. But now this, with the production going up, would reduce, because let's suppose you produce 1 car. So this is going to be $10,000 to be covered by that car alone. But if you produce 2 cars, then each car would actually be getting what? Like 10,000 by 2. So now you have $5,000. That means now for 2 cars, it could split up. So this cost usually gets split as the production increases, because if you have 3, 4, 5, 6 cars, then you keep dividing this, then the denominator would actually keep on increasing and this value would keep on reducing, right? There we have the variable costs, like direct material, direct labor, indirect labor. Okay, so these are, but indirect labor could also be a semi-variable cost, because this is tricky, because either you pay wages for hourly work, because if you pay them with time, this is a variable cost because it keeps varying with time. By varying, I mean variability. The variability keeps changing with time. So you produce, and then the workers there are helping you to produce that particular product or cost object. So then that means for the time period for which they are working, actually, this is converted into their wages, right? So this is a direct cost for you, and this is a direct labor cost. But for indirect labor, when it is semi-variable, it means a portion of it is fixed. It could be a supervisor's salary, like I just mentioned. Either it could be there to supervise a particular plant facility. Now that particular plant facility could have different makes. So for instance, you have BMW with X6s. This is a particular product that they might have, and some other product. So now, when you have 2 or 3 different brands being made under one make, BMW is one make, right? So they could be making sports cars, they could be making some luxury cars, and then others. So then the supervisor could be supervising only one range of production and not the other one. Could be supervising one type of model but not the other one. So then for that particular brand or car fleet, they could be getting salary for the amount of time that they spend there, or they could be paid monthly. So if they are being paid monthly, this would come under semi-variable, because now it is being paid monthly, but then it is also fixed because it's monthly, and semi-variable because for each production, the time for which they are staying in there, they could get paid for overtime if they stay there. For instance, they are going to be monitoring one particular brand of car but not the other. So for that, if they, let's suppose, now that supervisor says, I'm going to be monitoring 2 fleets, that salary would change, right? So that means, and he would say that since I'm going to be monitoring 2 fleets, I'll be working overtime, so you pay me overtime. Then that overtime could be, with this proviso that you work for 1 extra hour per day and we pay you $10 extra. So aside from having a monthly salary of, let's say, $5,000 for supervising that particular plant, he could be having a salary for working overtime if he wants to supervise the other plant facility or the other fleet or assembly line or inspect other cars. So whatever additional work that he does and he wants to get paid by the hour for that particular time, then that would be, a variable portion of that. So this is overtime would come as variable, but if he is getting per month, then that would be fixed. So when you have fixed plus variable, then that becomes as semi-variable, okay? Then medical insurance is fixed for each employee as per his salary. So when it is fixed for his salary, but then it ranges, it's the relevant range, I'm using the word relevant range. Okay, so this range is of, the amount of, this is the whole spectrum of products that we are considering. That is the relevant range. So our spectrum of inspection is the relevant range in this time. So when you see that the workers are being, paid insurance, being given insurance by deduction of some part from their salaries. So in that case, it's going to be fixed per salary, but keeps getting varied with the increase in the workers, right? So when an additional worker is added, the insurance amount would rise. So then this is, or get raised. So this is just the medical insurance. Let me just recap this. We have the supervisor's salary. Supervisor gets paid per month. That would be fixed portion. So now when he works extra, converting it into hourly rate, if he does some overtime, or maybe he does inspect another factory, anything additional that he does for hourly basis, then that would be the variable trend in this, okay? Other than that, there is heating and lighting. So this could be variable cost, but since the plant has to be heated or it has to be cooled, it has to be lighted irrespective of whether the goods are being made in all the facilities or not. Maybe there could be just running one line which is more active than the others because the demand for the product of that particular line is there. So we say then the cost would be allocated only to that particular fleet for production. So now when these are to be allocated, so now naturally the whole plant has to be switched on. Again, there's going to be a fixed cost for that. So that portion would be fixed for semi-variable costs. The other portion is variable because you will switch on the plant for as long as that particular car make is being subjected to production or it is under production. So if the manufacturing process continues, then the plant will be active, it will be, rather I would say that the facility would be in run, or it would be in running. Then we will have these costs allocated as per the amount of time or the duration for which it is, the plant has been switched on. and for which the facility is giving the cooling and heating, providing these for the particular elements that are being produced. For instance, there are some generators which have to be cooled, and then equipment has to be cooled, so then cooling has to be there, heating has to be provided, as per the time or amount of time for which the production is continuing over there. But variable because that particular production would keep on continuing to be produced for maybe 8 hours, 6 hours. So for that time, that electricity would be used. So it is variable for that, but fixed because the plant has to be switched on for amount of time. And even if there was no production, still there would be workers coming there, cleaning the factory, and it would be switched on for some time. So fixed because the entire plant's cost has to be not just allocated to one product, but could be allocated to some other product as well, because you still have to pay the rent, you still have to pay for the heating and lighting, for which you have to switch on the plant. Anyways, this is the entire plant, and it has semi-variable impact because this whole facility has to be switched on and remain active for a period of time before the actual production can start. So when that production starts, the time period passes, and you can have this as variable, but fixed because irrespective of the production, the plant lighting has still to be there because the personnel are working there. So now we're done with these. Let's just go ahead with some numerical, because I'll just take a small question because we did the format in the last class. And one small, there's a question in Matz Usury. So I'm just going to be starting with page 31. Page 31, so there's a question, it's a very small one. This is chapter 2. This is considering the format that we did in the last class, and you can just open that lecture and see the format. We have the finished good. This is question 1. This is actually the exercise. Okay, so this is exercise. Question 1. January 1. And we have finished goods inventory. Finished goods as $300,000. And during the year, cost of goods manufactured was COGM that we calculated in the last class. I mean, we just did the format, so we haven't really calculated it, but we can just, ascertain it with the help of the format that we did. And the value has been given to you in the question. I'll just read the question that on January 1st, the finished goods inventory of Manual Company was $300,000. During this year, Manual's cost of goods manufactured was $1.9 million. Sales were $2 million. Okay, so I'm going to be writing the sales separately. Sales is like, it's just like revenue, okay? It's nothing different. $2 million. And there's a gross profit of 20%. So we have gross profit of 20%. Now how much is the 20% of that? Let's just calculate this. I'll be using the mobile first calculator. So let's just say we have 20% of 2 million. Comes to about 400,000. Comes to about 400,000. Right, so when you subtract that, what do you get? So now if you look at the format that we did, we said that, if there was revenue, so you can just simply replace the word revenue with sales, minus cost of goods sold, and you get gross profit for income statement format. This is the income statement. Typical format that you have gross sales, that is revenue. You subtract the cost of goods sold, and you get the gross profit. So when you subtract the gross profit, you get the cost of goods sold. And in this case, it's going to be 1.6 million, right? You can just simply get $1.6 million. And you can just see this is cost of goods sold. It's a very simple question. So now we have cost of goods sold here as 1,600, right? This is cost of goods sold, calculated from this sales and gross profit. Now they're asking us that the cost assigned, they want to know what is the finished goods closing. Okay, so now for finished goods closing, you know the formula for the cost of goods sold. Okay, so this is basically the formula is, the calculation for cost of goods sold is opening finished goods, add cost of goods manufactured, COGM, and subtract closing finished goods, and you get cost of goods sold, right? So now you can just simply place in values. We have the opening finished goods as this. We have the cost of goods manufactured as this. Now we are going to be putting in closing finished goods, which is going to be closing or December. Finished goods. Finished goods as X, because we don't know what the term could imply in terms of value. And we have the cost of goods sold as calculated as 1.6 million. Now you can just simply put this here instead of this, and you can just simply find out the value. Because naturally this would come after subtracting this, so we can just simply add these up, and we can have, so we have 300,000 plus 1.9, and then subtracting 1.6 million. And you have about 600,000, okay? So now this X is equal to $600,000. This is your answer in this question. So now you basically play with the formats. Similarly, you have another question. So we're running short of time. This question number 2 is your homework. Okay, try to do question 2 with the format that has been given to you, and I'll move up the ladder with the level of questions, the level of difficulty. I have to go read for the now just open the book to the planning and control section. Okay, it's just one problem that I really want you to know, and you have to do with a few other problems to understand the concept of planning and control. And then we'll be wrapping up this lecture because it's about to go now, I think. I wanted to do other numericals, but I think we'll have to wait for the next class, and we'll be starting with the numericals, but I want you to do this reading. And this question was supposed to be basically the class practice. Now, we discussed what was planning. It's just basically policy making and control decisions, the implementation phase, and the 5-step procedure is given to you. You're supposed to read chapter 1. 1-28 problem. Just look at this. It says that postnews.com offers its subscribers several services such as annotated TV guide and local area information on weather, restaurants, and movie theaters. So its main revenue sources are fees for banner advertisements and fees from subscribers. Okay, just one thing. Advertisement is basically commercial cost, okay? And these form the operating cost. For now, just remember this. Operating costs plus manufacturing costs. Manufacturing costs and commercial costs would combine to make operating costs plus administrative costs. But right now we don't have administrative costs here. Administrative costs are basically relevant with the rent, the legal fees, the supervisor's salary, the stationery, the administrative staff, and all the other aspects like tax and other costs. Audit costs are also associated with that. Commercial costs are like advertising, printing, banners, like freight outwards for distribution, and customer costs. So these are commercial costs. So for operating costs, the manufacturing costs, commercial costs, administrative costs, all these combined to form the operating cost. Remember this plus this and this. So 1, 2, and 3. It's also in your books. Just read this. Now we have the fee from subscribers. Okay, so now it's supposed to be sort of like a magazine, like Time magazine. We have Newsweek, and then we have banner advertisements and fee from subscribers. The ones who subscribe for that particular, maybe some magazine or like some, some sort of service. They could have some subscribers for, it could be, it's an internet company, so it could be some information in soft or in hard form, right? So now, what they ask us is, you have to determine month-wise. In June 2015, the advertising revenues were $4,15,972. Actual subscribers, the number of people that from whom they actually earned this revenue, were 29,745, and the subscriber fee was, so you multiply this to reach this, $15.5 per magazine or per subscription for whatever services that they were offering. Now in December, that means after a span of 6 months, then again you can see that the revenue increased, partially due to increase in subscribers and increase in monthly fees. So both of these things. And then in 16, it further increased the revenue. As you can see that there is a trend that the revenue keeps on going up as the number of subscribers keep going up, and even though the subscription fee now remains constant. So you can also see that the policy probably changed, that they don't want to raise subscription fee at such a as frequency that it would put off the subscribers or the customers. Now the following decisions were made from June through October 2017. October, though, is not being it's not shown here. It's not being like evident here, but what they're trying to show you that this is the time span under which all decisions have been made. What decision? June 2017, they raised the fee per month. The budgeted number of subscribers is shown in the following table. So in June, after this period, okay, so these parts, A, B, C, D, E, they made some decisions. They raised the fee. In June, they informed the subscribers. In July, they offered email service to subscribers and upgraded other online services. Okay, they informed the subscribers. October, they dismissed the vice president of marketing after significant slowdown in subscribers and subscription revenue. So naturally, it comes up to the performance. If the performance is not good, they would rather fire the CEO, the management, or the person who is in charge of that position. So this is the supervisor, perhaps. In this case, it was the vice president. So now you have from July to September data which helped them to decide whether they wanted to keep the person or not. Then in October, they reduced the fee to 22.5. Perhaps they had further increased it to 23, and then they reduced it to 22.5. Let's just look at the table down. Now this question you have to solve, okay? First of all, classify each of the decisions as a planning or control decision. Okay, I'll just give you a hint. All these A, B, C, D, E parts, you have to decide whether they're planning or control, but rather I would suggest that you say in what way could they be planning and in what way could they be control decision, number one. And in part two, you have to give your own example of a planning and a control decision. That may be related with Post News or some other company as well. I can just give you that much leverage. But when you classify it, just remember that for part A, for instance, when they had decided upon a fee or they imposed that fee, you can just say which one of the decisions was a planning one or which one could be control one in part A. For part B, again, each part would have a planning and a control decision, okay? Instead of just writing whether part B is a planning and part C is a control, part D is planning, and E is control, no. You can, for each part, bifurcate how could it be planning and how could it be control. So you just work on this, and you can discuss with me in the Q&A session in the next class, and I'll just guide you on this. And question 2 of Matz Usury. So this was basically Horngren, 16th edition, okay? I'll end up my lecture here. Thank you very much.